legal limits of what they could do for due diligence, but certainly our agencies could have been doing a little bit more of a better job, including coming to us and telling us over a large number of years, a long number of years, that they couldn't handle the workload, that with the complications and the large number of investments and investors and the complications of the system, that they needed additional assets. We did not see that. We did not hear that. And we rely upon the administration. We don't have the tools. That's not the function of the Congress. We do oversight, which means we rely heavily on what the agencies tell us and ask, and try to supervise whether they're applying their resources, which they didn't ask for in this case. I have several questions to ask. In what we just heard in our testimony from this panel about the smaller investors versus the larger investors, is there a distinction in either of your minds in the morality of larger investors versus middle-sized investors versus small? Are one more immoral than the other? I'm not talking about specific individuals.
No, I simply don't know how to answer your question.
If you're wealthier and make investments, does that make you immoral?
Absolutely not.
Are they more suspect because they had?
Absolutely not. I think that's why the trustee, in the Madoff case in particular, has done a rigorous investigation of very complicated facts and started 14 lawsuits. Some of those lawsuits assert knowledge or a knew or should have known standard. Others do not. So certainly with respect to the former, the trustee is doing his job, and he is trying to return to the common pool of assets, defined in this case as customer property, the largest amount to distribute to the greatest number of people consistent with the law, and he's doing that. To get to your point on morality, I'd like to turn it to a case of practicality and compassion. The trustee has taken the position that he sent a letter to everyone who received more than they put into this scheme and said, come and talk to me. If you're, if it's something that you withdrew over time and you can't pay, but when the trustee isn't going after you, that makes no sense in any sense.
What's the difference if you withdrew it over time or if you withdrew it late in the game, rather earlier in the game?
The answer to that is, in all Ponzi schemes, going back to the original Ponzi scheme with Charles Ponzi, people who get out the day before, and Professor Coffey spoke to this rather eloquently, should do no better than the person who didn't have that good luck. And that's just been the law as enacted by Congress since at least the 20s.
So it's a matter of luck?
No, it should not be a matter of luck, sir. That's the whole concept behind bringing money back in. And I think in this case, the trustee has exercised his avoidance authority with discretion and compassion. He hasn't reached back to the small investors, particularly people who have no wherewithal.
Is it possible in your mind, speaking of compassion, that there are large investors, and I'm not advocating for anybody here, I'm just trying, and there's a problem, because this is a zero-sum game. When somebody gets somebody, it's coming out of the same pot of money of people who are all losers. Is it possible in your mind that you can conceive of situations, many of them, where larger investors are more desperate than some of the smaller investors?
I haven't seen that in this case, sir.
You think there are no larger investors, say someone with $100 million who's doing something and invested the rest of another $100 million because they're that big an investor and is now upside down in their real estate or house or business or property, despite the fact that they took money out and now they wind up paying having paid $50 million in taxes to which the government should not be entitled, have borrowed from the banks to do things on a business, have invested other people's money along with their own to do something, and are now being told that not only do they have nothing, but they owe back $200 million?
I can speak to a number of those points.
That's at least as desperate as the other people for whom I have great sympathy, who had $200,000 and invested $100,000 and lost it. They only lost $100,000. A lot of people aren't sympathetic because they think that's a lot of money, but they might still have some. You know, it's how do you morally make a distinction here? And is it possible in all this formulation that somehow you can come up with a Solomonic kind of solution and splitting according to some formulaic way how to deal with all these people?
Congressman Ackerman, I don't think a formula is the answer. I think analyzing individual situations is the answer, and I think that's exactly
each case individually?
Yes, sir. I think that's exactly what the trustees
If
do.
I was getting paid $1 million a week, I'd like that.
I believe that this trustee is acting...
I'm not questioning. I'm not questioning the trustee. I'm just pointing out the irony in this situation.
2 points. First, no customer money goes to pay attorney's fees or trustees' fees. That's point number one.
Where's that money coming from?
It comes from the Securities and Investor Protection Corporation. We have taken the view that every paper clip that gets sold would be designated to monies that go to the victims. The second point is that, you know, looking at these cases individually, our statute was designed to protect the small investor, and I think that's exactly what Mr. Picard is doing.
As I understand it, brokers, investment advisors are required to put into the fund to be covered by SIPC $150.
That is not correct. Currently, the assessments by our bylaw require each brokerage firm to be assessed 1/4% of their net operating revenues. When we started paying Madoff claims, we instituted, effective April 1st, assessments based on revenues rather than
Beginning
a flat fee.
when?
April 1st.
April Fool's Day?
Yes, sir.
Well, some people think that that's when you identify the people who've been April Fooled. That's after the Madoff Ponzi scheme fell apart because he turned himself in.
Well,
I mean, how does, you know, before that it was $150?
when we reached $1 billion, which our risk managers...
Yeah, but before Madoff it was $150?
When we reached the figure of 100...
I don't have a lot of time left, so if we could just focus on a couple of more questions.
The answer was based on revenues until 1990, when we reached $1 billion. Then from 1990 through April of this year, it was a flat fee.
Of?
$150. And we will have sufficient
That wasn't
funds.
hard. So before then it was $150. So if I was one of those brokerage firms or investment advisors, I would have to pay $150 to get that $500,000 worth of insurance?
Investment advisors are not part of the statutory program at all.
Okay, so if I was a brokerage, I'd have to pay $150 at that time?
At that time, yes.
So if I had, say, like 600 clients or customers, that would, give me a second, I'm a junior high school math teacher, but 25 cents an account. So for each of my accounts, I was in premium I was paying, I'd get $500,000 by charging people 2 bits each. Somebody should have come down here and sounded the alarm and say, I'm paying too little for insurance. How much insurance can I really buy for $150 for 25 cents an account? I mean, if somebody was charging me 25 cents an account for my car insurance, I would suspect that I wasn't getting a lot of coverage. No? Let me ask and answer. Let me go on to something else.
Okay.
If I may, Mr. Chairman?
We'll give you a couple.
Okay, thank you. People relied heavily on SIPC and the SEC, very heavily, for stuff that you can't expect them to be able to do themselves. That's the reason for SIPC, and that's the reason for the SEC. People can't become attorneys and investigators and spend their whole life investigating something, whether or not. So, you know, if you don't know if something's kosher, you ask the rabbi. And if the rabbi says it's kosher, by me it's kosher. You guys are the rabbi to all these people. When you say the guy was legitimate, he was legitimate. They relied on that. It was the indicia of your agency and my government that was on these products and the person who presented them that said that they were fine. People thought they had the insurance on money, whether or not it was the interest. If my account is insured, I don't differentiate between how much I put in. I figure my account is insured for up to $100,000 in my bank, now $250,000 for the rest of this year or whatever. And I don't say my interest isn't insured, only my principal is insured. Everything is insured. So it becomes a different number for everybody who had an investment over a long period of time. And as a matter of fact, it was you and your agency that testified in your testimony in the New Times case, where you say we're a claimant, or this is a quote, reasonable and legitimate claimant expectations on the filing date are controlling even when inconsistent with transaction reality. I'm quoting you. Thus, for example, where a claimant orders a security purchase and receives a written confirmation, which every Madoff victim did with every statement, reflecting that purpose, the claimant generally has a reasonable expectation that he or she holds securities identified in the confirmation and therefore generally is entitled to recovery of those securities within the limits imposed by SIPA. That's a financial limitation of $500,000 or whatever it is. Even when the purchase never actually occurred and the debtor instead converted the cash deposited by the claimant to fund the purchase. It seems that these people were again reassured that the way we wrote the law, the way the regulations existed, and the way you interpreted them, telling them that they're entitled to that money, even if, and I won't go on reading, even if their money tripled and there was no money there, even if they didn't have real money in the account because somebody fraudulently stole it. Now what's happened is we go to a different court case and you change your view saying that the money was stolen and not invested. I mean, this is a shell game that you're playing with investors who have, I mean, this is over the heads of most of the people on our committee, I would think, how this happened and that this is being done. People relied on you and they were let down, and we have to all collectively figure out a way to make all of them as whole as we can make them.
Thank you, Mr. Ackerman. Now hear from the gentleman from New Jersey, Mr. Garrett.
Thank you, and appreciate it. I think I just have a couple questions because I understand some of the other questions were covered. Mr. Harbeck, you raised, just as I was walking in the line, you're here to help the small investor, and I think that's what the message is and throughout the hearing, that's what we're trying to look out for. But raises three questions: time, money, and who. The time aspect of it is, if we're really trying to help out the small investor, and I guess we can define who that is later, how long does it take and still say that we're helping them out? Obviously, if it takes 10 years to do it, then we're not helping out the small investor. Obviously, if it takes 5 years, now it's been about a year. And at some point in time, you can just say, we are not helping the small investor. So what is the timeline that if we were to say, we invite you back here for another hearing such as this, you can say that we're done and the folks have been compensated to a large extent?
There's two points to that response. First, in the two largest cases prior to